Hello. This video considers the third question of the gross income checklist. Who includes the gross income? Recall that the first question is what amount is gross income, if any. If we did not have any gross income under that determination, we do not consider when, the second question, and who, the third question. It's important to consider whom the income should be taxed. It's broken up into two portions, income from services and income from property. Let's first consider income from services. Does the income represent compensation for services, or is the income attributable to services performed by a person? Now, as a main case, Lucas v. Earl, a U.S. Supreme Court case in 1929, the taxpayer who performs the services is the one who is taxed on the income, regardless of how that taxpayer designates where the money should go. Now, if the earner has no rights to the income, specifically if the person performing the services has no right to receive the income cannot be taxed to that person, even though he or she performed the services that generated the income. So the key here is that under Lucas v. Earl, which is a general rule, is the taxpayer that performs the services is a taxpayer that includes the amount in gross income. However, if that taxpayer has no right to get that income in no way possible, then it will not be included in gross income. Another example is in Teschner v. Commissioner, which a father entered a contest that would award an education annuity to an individual who was under a stipulated age. Because the contest did not allow for the father to receive any amount due to the fact the father was over that age, the amount went to the daughter. Even though the father entered the contest and created the service or performance that allowed for the income, the daughter received the amount and the daughter was taxed on the income, not the father. Again, the key is that the father had no ability to get that income. Under the agreement, the father was over the age. Now, when considering whether there's no right to income, we have to consider direction and control. If the service provider has the final say as to who receives the income, the service provider will be the one who's taxed. If the service provider disclaims all rights to the income and such income passes to the person related to the service provider likely would not be taxed on the income because the service provider had no control over the recipient of the income. In Commissioner v. Giannini, this issue is prevalent as one of the executives stipulated that his income go to a charity. However, the charity was not to be determined by him, it was to be determined by the board of directors. Giannini, though, was a member of the board of directors and had some say with respect to how that determination was made, but not full say. In that case, the court agreed that Giannini did not have full direction and control because, again, it did not go to him to make the ultimate decision. It was to the board of directors, regardless whether he was on the board. Let's now consider income from property. Is the income attributable to property? The main case in this area is Helvering v. Horst, which is a U.S. Supreme Court case that dealt with a coupon bond, where one party owned the bond, gave the right to receive the income off the bond to another party. We call this the fruit of the tree doctrine. So if you think of a fruit tree, here's a tree. That tree bears various fruit. Now this is known as the property tree because the property is the tree that grants the fruit versus the fruit itself is also property. If a party gives fruit that's considered income, such as interest on bonds, then the party that grants the transfer of that fruit will be taxable on the income when received. So we're saying here above is the fruit. This is just the fruit. If you're just giving the income, you're just giving the fruit. But if you give the tree and the fruit, all of it, then the party receiving the tree and the fruit will be taxed on any income coming off of that tree, which specifically in our example is the interest income from the bonds. Now there's an exception to this rule that says even if the property has vested income associated with it, a taxpayer can effectively shift such income by selling the property to the transferee instead of gifting it. So the issue becomes, if we give this tree and there's already ripe fruit, if there's already ripe fruit on the tree, the issue is, well, maybe that fruit ripened while the original owner had the tree. And therefore, while it was ripening, it should be taxable to the original party, even though it was transferred. However, a way to get around this is by selling it instead of transferring or gifting it. This is the last part of the checklist on gross income.